Welcome back. Today is day 2 of our 30-day options trading explainer series, and we are jumping straight into it. Yesterday, we laid down the groundwork, but today we're peeling back the layers to answer one absolutely fundamental question. It's a concept that is literally going to dictate everything else you do in this series.
So I want you to think about this for a second. What if you could trade something in the market without actually ever owning it? Sounds a little crazy, right? Well, that whole concept is what we call derivatives.
Section 1. What are derivatives?
Okay, let's dive into this. To really master options, you've got to understand the family they belong to. A lot of people hear the word derivative and instantly picture some complicated, crazy Wall Street math. But honestly, it's incredibly simple. A derivative is just an instrument whose value comes from or depends on another underlying asset. In the absolute simplest terms, it has practically no value on its own. It derives its entire worth from a completely different asset. And you know what? If you can just grasp that one single concept of dependency, you've already conquered the hardest part of today's topic.
Section 2. The real-life analogy.
Now, financial definitions can feel super abstract, so let's ground this in reality with something we all know. Think about the price of petrol at the pump. It doesn't just randomly decide to fluctuate, right? It depends heavily on the global price of crude oil. If crude oil goes up, well, petrol goes up. Petrol is derived from crude oil. Without crude oil, there's no petrol. And that exact chain of dependency, that is the entire idea behind a derivative.
Section 3. Stocks, futures, and options.
All right, bringing this back to the stock market. Derivatives get their value from underlying assets, like individual stocks, or maybe an index like the Nifty 50. If the Nifty 50 moves up or down, the options price goes right along for the ride. Just like petrol depends on crude oil, the option depends entirely on the index. If the underlying asset's price changes, the derivative's price changes. It's a mirror effect, and that dependency is exactly why it's called a derivative. Now, when you're interacting with a market, you're mainly dealing with 3 types of assets, and putting them side by side really makes the whole shebang click. With stocks or the cash market, you buy actual shares, meaning your core action is ownership. You literally own a tiny piece of that company. Now with futures, you agree to buy or sell an asset at a later date, which creates a strict mandatory obligation. You are locked in. But with options, you get the right to buy or sell, but absolutely no obligation to do so. So remember, stock equals ownership, futures equals obligation, options equals right. Memorizing these core natures right now is going to put you miles ahead of the vast majority of market beginners. Section 4. Common trading mistakes.
Part of mastering this stuff is knowing exactly what traps to avoid. Mistake number 1 is trading a derivative without continuously watching the underlying asset. I mean, going back to our analogy, that's literally like trying to predict petrol prices without ever checking crude oil. There's just no way. Mistake number 2 is jumping into options without the basics. Luckily, you're already avoiding this one just by being here and building this foundation with us. And mistake number 3, confusing futures and options. Mixing up a strict obligation with a flexible right can be a very, very expensive error in the market.
Section 5. Summary and next steps. Okay, let's lock this in before we go. First, a derivative simply means its value depends entirely on another asset. Second, options are just one specific type of derivative. And third, remember those golden rules we talked about? Stock is ownership. Futures are an obligation. Options are a right. Keep these principles close, and I promise you, the rest of this 30-day explainer series is going to feel completely intuitive.
We've got some bonus homework for you today, and it's super simple. Pick any stock or index today and just watch how its price changes. Really internalize that this underlying movement is the entire engine for why derivatives move in the first place. Doing this simple observation is going to completely change how you view the market. But before we wrap up, I want to leave you with a thought. If options give you the right to buy or sell without the obligation, who exactly is taking on the risk on the other side of that trade? Think about that, and we'll uncover the answer on day 3. See you then.